We're going to start off, we're going to continue now with 21st Century Property Direct. And this is really, I want to tie a lot of the concepts back from 21st Century Finance back into 21st Century Property Direct. This is my passion now. What I do now is I'm a property investor full time. I'm driving around all day talking to developers, builders in Melbourne. All my properties are in Melbourne. I've built up a substantial property portfolio over the last, well, I've been investing since I was 18. And I'll show you some of the transactions that I've done, some of the properties that I've purchased, and some of the no money down deals that I've done in Victoria. My advice to property investors is you can become successful in any state. It doesn't make a difference where you invest, whether it's regional, whether it's rural, whether it's inner city, it just doesn't make a difference. But what you've got to do is you've got to pick one strategy and master it. Now, the strategy that I'm going to be discussing with you is buy and hold, never sell. Now, there's a lot of different strategies out there, and they're all legitimate strategies, and a lot of people are getting different results with different strategies. With share trading, for example, with option trading, I would encourage you, and this is something that I've been doing option trading for a long time now. The most important thing you've got to know about trading shares is when to get in, when to get out. But what a lot of people teach you, and what a lot of people spend thousands of dollars on, is getting people to teach you how to get in and how to get out. So a lot of people spend thousands of dollars on courses, 10, 15, 20 grand, and all they get taught is how to get in and how to get out. They learn the mechanics of the platform. They learn technical analysis. They know all the indicators, but there's one thing missing. They don't know when to go in. They don't know where to get out. What I teach you in property is when to get in and how, and never get out. That way you'll never lose money. And then once you get in, depending on how good you bought the property and where it is, I'm going to show you how to leverage the equity of the property and create a lifestyle where you don't have to work. That's the goal with property. It's really about having financial freedom and financial independence, or the ability to choose whether you work or not work. So most people don't want to become millionaires, and it's probably unrealistic for most people to become millionaires. And that's not what Property Direct is about. We're not here to teach you how to become a multi-millionaire. All we want to teach you is how to get enough money, $50,000, $60,000, $100,000 coming in every single year, where you've got the choice of whether you go to work or not. And most people, that difference is tremendous, especially to quality of lifestyle. Would you agree with that? Yep. It's not about, oh, I'm going to teach you how to become, to make $10 million. I'm just going to show you how to make $60,000 or $100,000 per year. Once you do that, then it's up to you where you go from there. But I'm going to show you what level we can take you to and what we can do with Property Direct. So the main objectives with Property Direct is, number one, is to educate you. That's what we do. We provide unbiased education to our members. That's the number one function that we do. I'm going to talk about the Australian residential market. I'm going to show you how to structure and build your investment property portfolio, not from the financial perspective, but from the property accumulation perspective. I'm also going to talk about 21st Century Property Direct and the services that we offer, and how we can help you source properties directly from developers, and how we can help you build your property portfolio. I'm going to show you also specific property examples that we've got available now and that we've sourced for our clients. My main objective is to motivate you to take action. To take action and become financially independent and obtain financial freedom. Also, I'm going to invite you to join 21st Century Property Direct, which is a free service, and I'm going to also invite you to attend the 2-day Advanced Finance and Property Mastermind Workshop, which I'm running in Brisbane in January, on the 30th of January, 1st of February 2010. This is where you can spend 2 days with myself, a financial planner, a real estate agent, an accountant, a solicitor, and a quantity surveyor, and we're going to take you through step by step of how to build and structure a large property portfolio. The key distinctions that I'm going to cover today is, number one, I'm going to challenge your current underlying belief systems about money, leverage, and ownership of property. That's number one thing. And that's a very important thing, because a lot of people, they think they know how property works, or they have a perception of what it is to become a property investor. I'm going to show you what property investors actually do, because I deal with them every day. I'm going to show you their belief systems. I'm going to show you their relationship with debt and how they actually take equity out of property and how they live off that money. What's the mechanics behind it? Because a lot of people have a misconception about where the money comes from. Most people think it comes from rental, where in fact most investors that I look after don't even ever touch the rental. The rental's just there to allow them to buy more assets. I'm going to show you why finance is, and structure is the reason you invest in property. Property is just irrelevant at the end of the day. Now let me just show you a very simple example. And this took me a long time to realise. Let's say you've got two properties. Property number 1 and property number 2. Property number 1 returns 10% per year. Property number 2 returns 5% per year. How many people would choose property number 1? Yeah. How many properties would choose property number 2? But let's introduce a strategy. Let's say that property number 1 you just purchased using a 20% deposit from the open market. But property number 2, it's in an outer area, it's outer area property, but because you're using vendor finance, which I teach at the 2-day Property Direct seminar, where the vendor has left the 20% deposit, instead of buying one property for $500,000 using this strategy, you have in fact secured $3 million using this strategy. What's 10% of 500? What's 5% of 3 million? Which outcome is far superior? Yeah. What's the difference? Is it the property growth? But see, the second property is a crap property in that area. It's 100 k's from Melbourne or any major capital city. But see, what most people do is they think, if I just learn how to find these things, these properties that do 10%, I'll be fine. I'm telling you this is irrelevant virtually in the equation. Property investing can be as simple as this. How much money do you start off with? How much money you end up with? And in the middle is just stuff that you do. Strategies, structure, finance. Most people are obsessed by finding out the spillover effects and the worst property in the best street, and do this and do that, and make money on the way in, and make 100 offers, all this kind of stuff. The investors that we look after, let me tell you, they don't even focus on that stuff. All they focus on is structure and accumulation. Systematic accumulation of property is what's going to make you wealthy. And this shows that strategy and finance virtually always overrides the best property selection criteria. So all you've got to focus on, anyone can find good property, if you just got to find a system of how to accumulate enough of it to create financial independence. Would you agree with that? That's what it's all about. What you're going to learn is also how to build and structure a large property portfolio where you can retire on $135,000 per year tax-free. You'd like to learn that? I'm going to show you how to do it in 7 years. I'm going to show you, even if you stuff up, you can do it in 10. Today is not about getting rich quick. It's about getting rich slow. But it's very predictable slow. I'm going to show you why when we look at capital growth history. Take notes and write down your questions. Craig and myself, Craig, can you just wave to everyone there? There's Craig from 21st Century Property Direct. Craig has a finance background as well as property. He'll be here for the next 2 days. I'll be here as well. So come and see me if you have any questions. We'll be hanging around 2 days at the Property Direct stand. So please come and see us if you have any questions. Make sure all your questions are answered before you leave. The dumbest question is the one that you don't ask. You know, ask the most silliest question that as long as you get clarification, you've accomplished your goal by being here. You've invested time in coming here, and there's different people here in this room. Some people are starting out with property. Some already have a number of properties and they're at a different level. It doesn't make a difference what kind of question you ask, as long as you ask it. Feel free to book in a one-on-one with Craig during the 2 days, and myself. We're going to have some appointments available to people that want to discuss their options further and talk about 21st Century Property Direct and what we can do for them. So here is 21st Century Property Direct. 21st Century Property Direct is an unbiased educator, number one, on property investing and structure. That's all we do. You can literally just come to our events, get educated, and not use any of our services. And just go out there and use your accountant, your real estate agent, your financial planner, your solicitor, and everyone else. That's what we do, number one. We just provide education that is unbiased, which means we have no vested interest. Number two is we offer a unique property sourcing service, and we offer 21st Century property management services as well. We also do mentoring. We do one-on-one coaching with clients. Okay, we have a combination of different coaches, which I'll talk about as well. And we also do seminars and workshops. We not only do a 2-day workshop, we also do an express weekend, where after we teach you how to do due diligence over 2 days, we spend another day just looking at specific properties and developments, and then on Sunday we actually put you into a bus and take you around suburbs in Brisbane, in Sydney, in Melbourne, and Adelaide, and educate you about the history of different suburbs, and educate you about where the next boom area is going to be, where the best streets are and why, etc. So it's 2 days in the classroom, and then we do an advanced 2-day in the field. And after that, you've got enough information that you can just start building a large property portfolio. Why are we unique? We are unique because of the level of due diligence that we do. We've got a 52-point criteria that I've developed with Duncan Hall. Every property that we recommend to our clients have to pass 52 points. Now, I've spoken to a lot of sophisticated investors, and I haven't met anyone yet that knows all the 52 points. Most people got as high as 17. So consistent capital growth, proximity to infrastructure, etc., population growth, demographics, etc. So what we do is once the property passes the criteria, that's when we recommend the property to our clients. And I'll show you some of those properties. That is something that is very unique about us that I haven't seen anyone out there really educating or teaching people how to do. You can come also and get educated, learn the 52-point criteria, and just start implementing it in the market. The 52-point criteria is designed to outperform 90% of the market. So if your property ticks all the points, chances are it's a maximised property. It's got a very high probability of outperforming the average market. That's all we want. We want to stack the odds in our favour with property. That's all we're doing. No one knows what's going to happen with property. No one can predict the next cycle. But if we tick enough boxes, we know the odds are getting stacked against in our favour. Fundamental question to ask yourself tonight is this. Does the property have the correct fundamentals that I'll be discussing? And also, this is what we ask ourselves. When we look at property, does it have the correct fundamentals? And I'll go through that. Also, will it outperform the market medium to long term? The fundamental question to ask yourself is, does this strategy make sense for me? Not everyone in this room should be in property. Not everyone will become a successful property investor. Some of you should be doing shares, some of you should be doing internet-based businesses. It's just one strategy, property investing. Now, Australians have a love relationship with property because we all have a reference. Well, number one, how many people here live in a house? Yeah. How many have seen a house go up in value in the last 10 years? So we have an instant link with that first level, yes, we know it's equity. Number two, it's been publicised on TV and there's books about it, there's seminars, etc. People love property. But a lot of people shouldn't be in property because property is all about risk and debt accumulation. And some people shouldn't be accumulating debt because they've got a very negative relationship with debt. See, imagine you were conditioned, like my parents, for example, that all debt is bad, that you shouldn't have debt. And in fact, they spent 15 years paying off a house, principal and interest loans. They are never going to invest in property again. Do you know why? Because another investment property is another debt. They've just spent 15 years paying it off. They have a negative subconscious association with debt. Now, people that have a negative subconscious association with debt always find a logical reason why it's the worst time to invest. And they always justify it and they find a great reason. So you've got to ask yourself a question. Does this strategy make sense for me? Does this strategy suit me? And also, I'm going to show you the strategy. Ask yourself this question. Where would you be today if you knew this 10 years ago? That's what I want you to ask yourself. Because the next 10 years is going to be no different to the last 10 years. I've seen the same stuff mentioned in the last 2 property cycles. The same thing. The market's going to crash. These areas are going to go up. Let me just show you what happens to a person that has a negative association with debt, meaning that they deem good debt and bad debt all bad, and they want to repel debt. If you look at the market in Australia, it roughly does 10% per year, but there's an emotional high and a reactive low, right? People overshoot the market and then it goes down and up. But roughly the property market does about 10% in the major capital cities per year. Doubles every 7.2 years on average, 7.5, right? If you have a negative association with debt, what you're doing actively as an investor is you're finding logical reasons why it's the wrong time to get into the market. So this is what you do. And this is what I've seen a lot of people do. Number one is they're here and they go, okay, the market's recovered now, so I want to get into the property market, I want to buy it. Now, I don't want to overpay for property, so I want to make sure it's a recovery. So the market's recovered, I'm waiting, I'm ready, I've got a pre-approval. Suddenly, the market's recovered. Now, I don't want to overpay for the market. I don't want to overpay for the property. Now, suddenly, there's a market goes sideways a little bit. Now, if the market goes sideways, you want to stay and sit back and see what happens, which direction it actually picks up, whether it goes back up or down. If the market goes down, that's also, people say, that's a good time to buy, because I can get in and get it cheaper. So the market's going down now. Now, I want to buy a bargain. Now, wait a second, it's going down a lot. If I buy today, what happens if the property keeps dropping and next year it's even cheaper? I've overpaid for it. So I'm just going to wait and see what happens in the market. When it stabilizes, then I'm going to go in. The market goes sideways, it's stabilizing, but is it really stabilizing? Because it could be another correction, right? It could go up or down. And I've seen people just follow the market, and this gap between there is about 10 years. And they've done nothing. And they keep sitting on the sidelines because interest rates could go up, unemployment could go up, this could happen, that could happen. You know what? It all just happens. It goes up and down. It doesn't make a difference. It's not the timing of the market, it's the time in the market. That's the key. Just get in. You'll never be able to pick the bottom of the market. Even the data that we use is 3 months old. So we don't even know when we're there until it's 3 months later. To begin is the most important part of any quest and by far the most courageous. Who would agree with that? The most important thing about investing is just to get in. Buy something. Buy anything. Even if you make a mistake. Now, who remembers in 1999-2001 two-tier marketing companies in Queensland who ripped off a lot of Victorians? And there were these people in current affairs crying. We came to Queensland. They flew us over, and we thought it was the only tower being built over the next 50 years, and we overpaid $70,000. And the valuer was in on it, and the solicitor was in on it, and it was $270, but we paid $350, and now our lives are destroyed. Well, guess how much those properties are today? You can't even construct them for $350,000. Where's Current Affairs now doing stories about those people in 2001, showing how the grandmother, even though she lost 70 grand, by 2003, the property actually became valued at what it was originally, and now she's got another 300,000 in equity. Where are those stories? See, the property market is very forgiving, isn't it? Even if you stuff up completely, you can still, long term, it's virtually impossible to lose money on property in Australia. Unless it's a studio accommodation or something near a toxic dump, okay? Which also people have bought, unfortunately. Now, your current knowledge base is divided into different segments. I'm going to spend a bit of time on psychology and get into property. There's stuff that you know about property. There's also stuff that you don't know about property. And then there's stuff that you don't know. Who didn't know that they didn't know that there was such a thing as forward loading? Or that principal and interest loans are outdated as a product? Yeah. It doesn't mean that that knowledge didn't exist. You just weren't aware of it. Now, there's a lot of stuff out there that you think you know about property, and there's a lot of stuff that you don't know that you don't even know. There's hundreds of people just implementing it every day. What you want to do as an investor is you want to minimize this segment of your knowledge base, the stuff that you don't know, because that's costing you a lot of money. Now, people always say, well, you know, education's expensive. You think education's expensive? Try ignorance. Try waking up at 85, realizing that you could have done all this stuff, but you've done nothing with property, and you've just raised the kids and they've gone and you've done nothing. That's expensive. The knowledge, the money that you're spending on your education is just virtually nothing compared to the opportunity cost of not implementing. I would encourage everyone in the room to spend at least 10% of your annual income on personal development and education every single year until you are exactly where you want to be. If you're on 40 grand, you should be spending 4 grand every year. If you're on 80, spend 8. People buy a Commodore for 35 grand, they drive out, a year later it's worth 25 or 20. They lose $15,000, $20,000 in consumable products like there's no tomorrow, without even blinking an eye. But people won't spend money on education. Isn't it crazy? Because it's too expensive, Konrad. It's accommodation and flights and all this stuff. I mean, I've spent tens of thousands of dollars, at least easily over 100,000 on personal development and property education, and I'm still spending money on my personal development every single year. Never stop learning. The learning curve has 4 distinctive stages as well, and this is what you've got to be aware of. When you start off something like property or finance or share trading, you start off unconsciously incompetent. You don't know what the hell you're doing. Then, if you start losing money, you become aware of how incompetent you are. You become consciously incompetent. And then, okay, which is the expensive phase. You're becoming, oh my God, I'm really crap at this. I'm losing money. Then you've got to get consciously competent. That's when you need a coach or you need a benchmark. Someone that can say, listen, you're doing the wrong thing here. You need to stop what you're doing and do this. And then eventually, if you persist enough with property and finance and shares, you become unconsciously competent, which means that you're doing it for so long, you can't even articulate what you're doing. It's like who's been at work in a job more than 2 years? You've gone through the learning curve, right? You don't have to go there every day and relearn what you're doing. It's autopilot almost, isn't it? It's boring. Think about the first day when you're at work, when you're brand new. No idea what's going on. Can't even send an email. You know, where are the toilets? All that kind of stuff. This is the property market in Sydney since 1901. In current median price is just under 600,000. If you were lucky enough, 100 years ago, you could have picked up a property in Sydney for $1,000. Now, have people lost money in the property market in Sydney? Absolutely. Will people lose money in property in Sydney? Absolutely. If you bought a property and you have a buy and hold strategy and you never sell, can you lose money in property? So that's an important point. And write this down, if you never sell a property, you can't realise a loss. Would you agree? Tell me how you can realise a loss if you don't sell something, if you don't complete the transaction. Warren Buffett says, be fearful when others are greedy, be greedy when others are fearful. It's a powerful statement, isn't it? What was Warren Buffett doing 16 months ago? Buying hard. He was buying all the stuff out there. Now, was there a lot of doom and gloom in the media? Were people saying the sky's falling, the banking system's going to collapse, the property market's going to collapse? Dr. Keane saying the property market's going to drop by 40%, I'm selling all my properties? Did people panic? Will it happen again? Is it cyclical? Yes. Absolutely. See, all these things are events, and events are going to continue to happen from now to the end of time. But there's a choice. When events occur, you have a choice. You can either react or respond. 95% of the market is reactive, 5%, the investors, are responsive. The difference is the ability to conduct unbiased due diligence. This is the thing. It takes me 7 minutes to make a decision about whether I should buy a property or not. 7 minutes. In my 2-day seminars, people time me. And this is the thing, and I've been talking about this to Jamie McIntyre and other speakers, and this is so true. And Jamie said this. Jamie said to me, from all the years of dealing with wealthy individuals, he said, wealthy people make decisions very quickly, and they take a long time to change their mind. Unwealthy individuals take a long time to make a decision, and they change their mind very quickly. It's very fun. I mean, this is just one of these key points that you pick up that just changes everything. And the only difference is that in property, and I've been doing it for so long, I just know how to do the numbers. I know how to do complete due diligence, and I can teach it to other people. That's all it is. If there's uncertainty, there's fear and indecision. Would you agree? And that's all you've got to do. As an investor, all you've got to learn is how to crunch the numbers, how to do the due diligence, how to learn the criteria, how to assess the opportunity. People say stuff like, you've got to be at the right place at the right time to make money. Who has heard that before? You know, I disagree. I think you've got to be at the right place at the right time and have the awareness to identify the opportunity. Would you agree with that? Because you've probably been hundreds of times at the right place at the right time, but you weren't aware of it. blocks that are waterfront blocks. Think about 10 years ago, around Queensland, if you had an opportunity to buy waterfront property, how much you would have made. But you just didn't know how to do the analysis, the due diligence. And that's the key, and that's the most important thing you can learn as a property investor. And that's what we teach at Property Direct. Now, let's look at the current financial results of Australians at the moment, because we talk about the 95% club a lot at the Academy. 95% of Australians retire broke. Well, you know, I was very skeptical when I heard that statistic. I unfortunately studied stats as part of my degree, and we used to have this saying, there are lies, there are damn lies, and there are statistics. So I actually went back and I tried to find this study that actually shows this 95% club, because everyone keeps talking about 95% of Australians retire broke. I said, really? It's exactly 95%, he said. So every year, 5% exactly, like to the person, but you go there, and you guys are all broke. So I actually went through and I was trying to find the actual study, and this is the study that I come up with. And this is the 2006 census of population and housing in Australia, gross individual weekly age and sex, etc. That's the census number there. Now, the reason I look at census is because it takes into account a lot of the population. So that's the actual study there. Now, I'm going to magnify it. And if you can read out the bottom number there, can someone read out how many people are we talking about here? We're talking about a sample of 15,918,000. Now, how many people in Australia? 21? Is that a fairly good sample? It's not like a new idea, phone in and 100 people ring up, right? That's 15 million people. That's pretty much all you can capture, right? Unless you force people to give the information. Now, if you look at the last table, this is how much Australians are actually ending up with in terms of living. If you look at $150 to $250 per week, 2.2 million Australians over the age of 85 are living on less than $250 a week. Can you tell me how that's possible? Like, what could you do on $250 a week in Queensland? Seriously. If you look at that, $600 a week, look how many, there's 8 million people are living on less than $600 a week. 95% of people, and I'll show you the actual, and I've crunched the numbers on this, and these are the actual numbers, these are the results. 40% of Australians retire or earn less than $400 a week. 40% of Australians. A massive 70% of Australians earn less than $675 a week. Only 2.2% of Australians earn more than $100,000 a year. 2.2%. Isn't that ridiculous? A massive 81% of Australians who make it to the age of 65 live on $400 a week, which to me is just barely paying bills. 1.3% of adult Australians who make it to 65 earn $1,000 a week or more, which is really what you need, isn't it? You need at least 1,000 just to do something, to go out once a week and have a holiday once a year. So to me, it's 98.7% of Australians really retire broke. Why is it so? Number one, it's poor wealth psychology. Does the school system in Australia teach us how to make money? No way. What does it teach us to become? Consumers and employees, yeah? To be taxpayers for 35 years and get a mortgage and pay off that mortgage in 35 years' time. That's what they teach us. Too lazy or too busy to learn how to create wealth. Do you know how many friends of mine I've invited to seminars and events for the Academy for free? Do you think they turn up? They're too busy working 60-hour weeks. They can't go, too busy. Never started to invest. You know that perfect moment, people, you know what, once they're 2 years old, we'll do it. Once they get the braces, we'll do it. Once they start primary school, we'll do it. Once they do high school, we'll do it. Once they get their license and they're 18, we'll do it. Once they get their first property, we'll help them with that and then we'll do it. I would often say, you know, what if this is as good as it gets? Just jump in and do it. Fear of borrowing money and having debt. I would say this is the number one problem with the way we are educated and conditioned by family, friends and peers, is the negative relationship with debt. Now, obstacles to financial independence, and this is what we teach at 21st Century Property Direct. Over the 2 days, we'll teach you what the main behaviour is of people out there and what individuals like investors, what they do. And the average person avoids or fears investing, number one. Number two, they buy things that cost them money. They buy cars, they get chattel mortgages, high purchase, vehicles, consumables, plasma screens, right? All that stuff that really doesn't appreciate in value. They have bad debts, credit card debts, personal loans. Pay full tax. Get advice from uninformed friends and family. I say to people, if your friend or if your neighbour is such an expert, what is he doing living next to you? Work harder. My parents thought, if you want to make more money, get a second job. Work overtime. If you work overtime, you just pay more tax. Lose opportunity and procrastinate and lose time. Wealthy individuals or educated investors, what they do is they know they must invest. Number one, they buy things that make them money, assets that appreciate. They use good debt as a tool, which I'll show you how to do. They minimize their tax. I had clients in banking where they were making $400,000 a year and they were paying $8,500 in tax, because of all the negative gearing benefits and all the investment in managed funds they had. So who pays more than $8,500 in tax? Difference is they've got better consultants than you do. That's all it is. Now people say, yeah, but consultants cost money. Well, let me tell you, the most expensive advice that you ever get is free advice. The cheapest advice you get is when someone's charging you $1,000 an hour in terms of opportunity cost. Would you agree with that? So definitely get advice from experts and specialists. Get advice from people that know what they're doing, that have proven results in the current market. Work smarter, not harder. Use opportunity and time and take action. Educated investors just take action more often. They can't pick the perfect time to invest. They just invest as quickly as they can and they buy as much as they can in a manageable way. This is the property investors pyramid. This is what I want to go through very quickly with you. And this is basically how we approach investing. Number one is you've got to get the knowledge. Once you get the knowledge, you get an investment plan that is specifically unique to current situation, because everyone's at a completely different situation in this room. The second thing is you've got to get the finance. You've got to get a mortgage broker. You've got to get a pre-approval. You've got to know how much you can borrow. If you can't borrow, you've got to find out why and what you have to do to change so you can borrow money. Then you see an accountant, 21st century accounting, asset protection, and tax advice. Everything that we do through trusts. Now, even through trusts, you can still claim negative gearing benefits against your PYG income. We just set up the loans where the loan's in your individual name, but the title of the property ends up in the trust and you borrow the money back to the trust. The way we set it up is quite unique. It's quite complex. How many people have an accountant here that has told them if you settle a property in a trust, the losses or the negative gearing losses, which are cash and non-cash deductions, are contained within that entity? Change your accountant. Warren Black will be speaking tomorrow about from 21st Century Accounting. Warren's a solicitor and an accountant and a financial planner, and he worked for the ATO for 10 years as an auditor. I'll bet he knows a little bit more than your accountant. Accountants come and see him just to learn from him on how to do it. Negotiation, property due diligence. You've got to find the property. You've got to know exactly what due diligence to apply to the property to find out that it's a maximised property. Negotiate a discount if you can, or buy in bulk, or negotiate terms of settlement, which we teach you, and then transaction. Transaction meaning get a solicitor. We don't use conveyancers. We recommend solicitors. Check the contract of sale. Put clauses in the contract of sale that protect you, subject to finance clause, subject to building inspection, etc. That's what we teach over the 2 days. And that takes 2 days to teach, step by step by step. The beauty of it is just a logical sequence of events that we do with every property transaction. The first one's the hardest. As you do more, it gets easier and easier. So step one is knowledge. If you look at the Australian property market, the fundamentals are there. We've got unprecedented population increase. We've got severe undersupply of residential property. Why? Because of building restrictions, permit restrictions, and also credit. Credit has been squeezed. Builders and developers cannot get funding for properties. Outer area properties in Melbourne, there is a virtually infinite supply of house and land in Melbourne. There's a lot of propaganda out there about people saying there's scarcity of house and land estates. There isn't. We have 27 estates that we have access to in Melbourne. I deal with two of the biggest developers and builders in Melbourne. One of them has nearly 10,000 blocks of land that he can release anytime he wants. There's no scarcity in house and land estates. The scarcity is in established areas, in suburbs where there is no more land, where the area has been built up 50, 100 years ago, and there are height restrictions and development restrictions. That's where the capital growth is, not in outer areas where there's virtually infinite amount of land. And I'll show you examples of that. Increasing rental yields. We know there's going to be a lot of rental yields. The low doc loans have taken a whole segment out of the market completely because of low doc changes. Self-employed people can't borrow money, so they have to rent. It's that simple. That's why rentals are going up. Low docs are gone from the market. So if you're self-employed and you can't show 12 months BAS statements, you can't borrow money. So that you're going to be renting, and that's created a lot of pressure on renting. Plus, obviously, we've got lower interest rates, but also all these people coming into Australia, tightening lending policies as well. If you look at the housing prices in Australia, this is the interesting thing. Let's talk about Brisbane. Brisbane, in 1966, the median price was $9,700. Now, in 1976, it went up to $30,000. Now, properties in Brisbane have always been extremely expensive. In fact, properties in Australia, people think, oh, 9,000. Who goes like, man, I could have bought like 100 of them, yeah? Who thinks that way? Property prices have always been very expensive. In fact, they have been as high as about 60% of the average household income going towards the mortgage in about 91, 90. So don't think that property prices were ever cheap in Australia. Property prices around the major capital cities has always been extremely expensive and completely unaffordable as a percentage of the average household income. Imagine you said to someone in 1976 that properties would double to $60,000. What do you think they're going to tell you? You're insane. Who's going to buy them? We can't pay our mortgage right now. We're struggling now. You're going to tell me that everything's going to double? And what happened? It doubled. And imagine you said to someone in 1986 that property prices in Brisbane were going to go from 60,000 to 132. What do you think they're going to tell you? You're insane. We can't afford to pay our mortgage currently. Well, you're going to get suddenly an influx of millionaires into Australia. And guess what happened? It doubled. Imagine saying to someone in 96 that in 2008, properties are going to go from $132,000 to $475,000. That's insanity, isn't it? How could that happen? We can't afford our mortgage now. It's never going to happen. It happened. Imagine now people saying the properties in Brisbane in 2019 are going to be $1 million. That's impossible. How could that happen? Now, I'll show you exactly why it happens. Because when people buy a property, and I'll use Melbourne as an example. Let's say, for example, we use Kew or Camberwell, which are very affluent areas. The average property is about 1.8 million. And people think, well, how can they keep on going? Well, it's going to go to 3.6 in about 5 years. People go, that's impossible. The people that are buying this property, that's not the first purchase. They've rolled over at least 4 properties into this market. So they go from one property to another, rolling over equity, from one property sale to another. See, in Australia, 72% of properties are owner-occupied, 8% are government-owned, and 20% are investor-driven. So these are the current stats. We've got 72% owner-occupied, 8% government-owned, and 20% are owned by investors. Out of the 20%, 80% of investors have one investment property that they've purchased within 3 kilometres of where they live, to keep an eye out for it in case it runs off, you know? Because one day you wake up, you'll be driving, shit, it's gone. So 72% of houses in a good area, over 1 million, are owned by people that live in that house. Now, when people say, well, these suburbs can't possibly continue to grow, Saying that is number one, is people don't realise that these properties are the fifth or sixth purchase or second purchase, whatever. When we do a purchase for 1.8 million at 21st Century Finance, the loan's only for 300,000 or 400. The rest of the equity comes from the previous sale. The moment the queue or those areas will drop in value is when people in queue wake up one day and go, honey, what do you reckon? I reckon we should sell and go 60 Ks out. Let's go to an outer area. Let's get our kids out of private school. Don't worry about the 25,000. Let's go 60 Ks out and go to a public school. Do people always upgrade? Do they have this drive to always get better and better? Do people upgrade the cars, or do they start off with a Beamer and then keep going down to a Datsun 180Z? What do people do? They keep upgrading, don't they? They never downgrade. So unless all the people in those suburbs get together, have a big council meeting and say, listen, I reckon we should start downgrading from now on. And that's the only reason that these suburbs will actually lose value. They're going to go up to 3 million, 5 million, they're going to keep going, and they're going to be completely inaccessible to most Australians. That's the fact. That's happening in all the major capital cities, and it's never going to change, unless human beings suddenly start downgrading themselves. These are the population growth in the major capital cities. Have a look at Brisbane. 2007, 1.8 million. 2056, 3.9. There's going to be another 2.1 million people coming to Brisbane. Where are they going to be living? Have a look at Queensland. You've got 4 million people living here now. You've got another 4.5 million people coming to Queensland. It's the fastest growing, it's probably the best market in Australia to invest in, apart from, unless you've got specialised knowledge in Melbourne and Sydney, Queensland is the best state to invest in if I had to compare states. There's so much drive for properties here, so much opportunity. You've got the fastest growing population growth out of any major capital city. Do you think property is going to devalue or go up? Absolutely. Do you think people are going to live 100 k's from infrastructure, or do they want to live as close as they can to the action and to the cities? Yeah. It's really that simple when you look at it. Supply and demand. There's the demand, there's the supply, there's the gap. We're not building enough houses in Australia. We haven't got an industry that can sustain the volume that we're after. You've got a chronic housing shortage, you've got rents going up. Now, if you look at the National Activity Index through RP data, we can see that November was the lowest point. We've recovered. The recovery is here. The doom and gloom is gone. There it was. This was the best time to buy property in December, January 2009. This is where we're getting 60, 70, 100 grand off the valuation of brand new townhouses 10 k's from the city in Melbourne on the waterfront, because developers thought, they bought into it. They thought the sky's going to fall, they thought the banks was going to recall the loans, they thought they're going to go under. And they need to sell, and there was no one wanting to buy. That's the best time to buy property. Now, it's just an average market. It doesn't make a difference whether you go in now or later on. This is where everyone fears the market. That's where you go in hard. Clearance rates are about 80% in Australia, in different major capital cities, like Melbourne, for example, Sydney, etc. Number two is have an investment plan. I'll show you the accumulation plan. You can do this even with house and land estates. And I'm going to show you one property that couple purchased with no money, and I'll show you the exact property. So let's say we're looking at house and land estates. If you're looking at, say, Queensland or Victoria, you're looking at 8% capital growth per year. Is that an aggressive growth or just a realistic growth? It's fairly realistic, isn't it? 8%. So if you buy a property in year one for $450,000, the same property in year two will be worth $486,000. And it keeps on going up every single year. In year 10, the property doubles. Okay? Now, do we know this is going to happen for a fact? Not a fact, but there's a likelihood that it's going to happen. Has it happened in the past? Yeah, it's happened for the last 3 property cycles. Properties have gone from 130 to 250 to 500. So there's 3 phases of the accumulation phase, 3 phases of the retirement system that we teach at Property Direct. The first one is the building stage, where you're building, you're setting up all your structures, you're getting your asset protection in place, you're getting your financial structures. Number two is the accumulation, the consolidation stage, where you've accumulated some properties and now you might sell one of them. Maybe something has happened with some of the properties that you've purchased where you've changed your strategy, or you're refinancing some of the properties, or you're acquiring new properties. So you're consolidating what you currently have. The third stage is the harvesting stage, where you're getting equity out of these properties and you're living off the equity out of the properties, which I'm about to show you now. Your plan will vary depending on your risk profile. What I mean by risk profile is how confident you are with debt. Now, question is, how confident am I with debt? Well, when you have 3 million in debt, you'll find out. You can either sleep at night or you can't. So this is the 10-year fast-track retirement system that we teach our clients, and we do this with our clients. With my private mentoring clients, I've got clients who have done a property every 2 to 3 months. I've got clients who have done 4 properties in the last 12 months. So it's not 10 properties over 10 years. That's easy. Some of my clients, I'll do that in 2 years. So let's say for year 1, you buy a property worth 450. Now what I've done in this example, I've taken compounding and capital growth out of the equation. I just want to show you the numbers and the figures and how they work, because the moment I introduce capital growth, it becomes dollars and cents and people lose the whole illustration or the aim of the illustration. So year 1, you buy a property for 450, year 2, year 3. Now obviously in year 10, you can't buy the same property for 450, it's 900,000. But I've left it the same price in today's dollars, okay? Now what happens is, in year 11, the property doubles, and it doubles to $900,000. So this is how you actually get money out of these properties. Your property goes from 450 to 900. 80%, if you refinance that property, 80% of 900 is 720 minus the original debt. What are you left with? It's right there on the board. You can cheat. 270. So you've got $270,000. Now you split that up into 2 lots of 135,000. Let's say your line of credit costs you 6 to 7% to 8% per year over the time. And let's say that your cost of compounding your interest costs another 2%. So if I was to ask you, if you're paying 10% altogether to have $135,000 outstanding, how much are you paying per year? 13,500. How many lots of 13,500 are there in 135,000? 10. So how many years could you hold on to that 135 outstanding for? 10 years. So what happens year 12? Another property matures. You've got another line of credit for 270. What happens year 13? So this is your income here. Now people say, well, surely the banks just can't give you money out all the time. Yes, they can. Why? Because what's servicing this debt? Is it your PYG income? It's your rental, isn't it? It's 80% of your rental. Rental's going up at around 6% per year. It's 2% above inflation. So yes, they can keep cashing out your properties and giving you a line of credit. So these are the lines of credit that you have in year 11, 12, 13, 14, 270. That's $135,000 tax-free every year for 10 years. And then what happens in year 21? Your first property goes from 900 to 1.8 million. You refinance that property at 80%. You've got a line of credit for $720,000. That allows you not only to pay for the other 270, but to take out another $135,000 tax-free. And you keep drawing down and living off your line of credit. And then what do? And then you die. And your death cover pays out all your properties, and because you've purchased them in separate trusts, in bloodline trusts, and they're all standalone, your death cover pays them all out, your beneficiaries get them all unencumbered. The worst thing you can do is to pay off the principal of a property in your lifetime. That's the silliest thing you can do. Why not get the insurance company to do it? Who likes that strategy? Now, how do you live off your property? There's different people here that go, ooh, that can't be good. You're just borrowing Like my parents would say, that's got to be bad, it's got to be illegal, at least it's got to be fattening or something. You can live off your line of credit, number one, and keep capitalising your interest. Or you can take a line of credit and you're going to learn strategies. One of the most conservative strategies you're going to learn over the weekend is how to do Sharelord, for example, which generates 3 to 5% per month. What's 3 to 5% per month on 100,000? 3 to 5,000. Does that take most people out of the work and gives them the opportunity to quit their job? Yeah. So if you need more than that, 200,000. So you get a line of credit, trade shares. Or the most conservative one is to accumulate enough property where you sell half of it and pay out in all the others. So let's say you buy 12 properties, sell 7, pay out the other 5, and live off the rental income of 5 unencumbered investment properties. So if your goal is, for example, to live off $250,000 per year, you need $5 million unencumbered assets making you 5% per year. So you might need to secure 12 million with property, sell the 7 to pay out the other 5 and have that unencumbered. That could take you longer, 10, 12, even 15 years. But eventually you're living off the rental, which is fully taxable, which is probably not the best ideal. Number 3 is finance. So that's the second thing we teach. Become an expert on structuring a large property portfolio. Do you need to structure this correctly from day one? Can you wake up at property number 6 and go, oh crap, I've got to structure this somehow? What do you reckon? Day one. You got to put the fundamentals in from day one. It's all about planning. It's not about guesswork or getting 3, we bought these, they're not the best, but now we know what to do. It's getting everything right from day one. That's the most important thing. Get a pre-approval from 21st Century Finance. Work out your maximum borrowing potential, LVR. Get a couple of brokers to give you an idea of what you can borrow. Find out what you need to do if you can't borrow. Obtain a copy of your credit file. Empower yourself with a pre-approval letter. Asset protection and tax advice. Become an expert on asset protection and tax minimisation. You need to know the difference between different types of trusts. You need to know the difference between a family trust, a unit trust, a hybrid trust, the tax implications and how they distribute income. If you don't know that, you can't do this strategy because this is a very important component of it. You need to control everything or nothing. Understand negative gearing and the income tax withholding variation form. Let me just show you the negative gearing example. And this is basically the couple that came to us. They came to an event, and just call them Bill and Mary. And I'm not revealing their true names. And also, their incomes were roughly 55,000. She was actually on about 53. He was on closer to 60. But I'll show you the property they purchased and how they did it. They came to my event. They had a couple of kids, and they said, "Listen, we've got an owner-occupied property for 350. We've got a mortgage for 294. We know we need to buy property, but we can't save a deposit. We're spending everything we earn, and we can't even spend." And I said, "Well, how much can you spend a week?" "Nothing." I said, "What about $5? "No." "What about $1? "No." I said, "Well, I'll tell you what you need to do. You need to, do you have parents with equity?" I said, "Yeah, our parents have a house, it's unencumbered." "You need to bring them to the next event. We're going to refinance their property, set up a line of credit. They're going to put the deposit into the property, register a caveat against the property, and you have to pay them out in 5 years' time when you get enough capital growth." So they did. They came back with their parents the next day. Next time we did a property seminar in Melbourne, they came back. The parents listened for 2 days. They refinanced their property. They put the deposit down for the property, and they put it. And I'll show you exactly what the transaction looked like. And they bought a property for $400,000. Now, the value of the property is $400,000. Okay, it's in the Bring Back Garden Estates in Melbourne, which is an estate about 9 k's from the city. Because it's off the plan, the stamp duty is only $13,081 on the land component only. The income, and I did this just under Bill's name, is $55,000. He's paying tax currently of $11,325. The rental on this property is $350 a week, and I've also allowed 2% vacancy rates. That's why it's $18,018. So the total income, what actually happens to your income is your rental just gets added to your normal income. It's like a second job. And then before you pay tax, you get to claim your deductions. Deductions on this property in the first 12 months were $32,185. I'm going to show you exactly how they got that. So his income dropped to $40,833, and the new tax that he's paying is $6,862. From the previous slide, new income, $40,833. New tax that he's paying on that is $6,862. So he's saving himself $4,463. That money now is going back into his property. It's going away from the ATO straight into his property, okay? Which means he's saving himself $85.83 a week. Now, how do you get to these deductions on these properties? Deductions are depreciation on the fixtures and fittings and building depreciation. The building can be depreciated over 40 years at 2.5%, and the fixtures and fittings have their own lifespan of about 1 to 5 years, 1 to 7 for a lot of them. We use BMT as the quantity surveyor for all our properties. BMT is one of the best quantity surveyors in Australia. They speak at all my events. They do all these depreciation schedules for our clients. Interest only component, $18,386. And the property costs, $3,968. The total cost to them, $32,185. That's the deductions they can claim on the property in the first 12 months, meaning, according to the ATO current rules, that's the wear and tear on their property in the first 12 months. The weekly cost can be broken down into finance, $353.58, $76.31 for rates, maintenance, $428.88. So this is how the transaction looks like. The property actually costs you a bill $429.88 minus the rental of $350 minus the tax that he gets back with every pay cycle. I'll show you how to do that. $85.83. So he's actually making $2 per week. It's cash flow positive through negative gearing. How do you get to claim the $85.83 every pay cycle? I'm about to show you. This is the exact transaction with the actual loan. We went through CBA, we got a 5.04% interest only loan. That's the investment cost. That's the pre-tax cash flow. Normally this property would cost him $4,355 per year if he didn't do one thing. And the thing that he had to do was the income tax withholding variation form, which I'm about to show you. Now, if you look at this property, is he going to make a lot of money out of the rental? Have a look at the rental. The rental's virtually relevant, isn't it? What's important is the equity position. So in year 3, he's got $139,000 in his property. That's what we're going to refinance and pay his parents out in year 3 or 4. In year 5, we're going to buy another property for them because we've got enough equity there to get started. The way you can claim this is through claiming depreciation through the 2009 ATO income tax withholding variation form. This is the form that you need. It allows you to claim your deductions based on depreciation schedule of building fixtures and fittings with every property, with every pay cycle. So it's like salary sacrificing, basically. There's the form there, and there's the actual section in the form that allows you to claim negative gearing. So if you can see there, if you can make that out, it's the section that is negative gearing, real estate, property investment. This is the estate they purchased the property in. It's called the Bring Back Garden Estate. It's 7 to 9 k's from Melbourne, 15 k's from the airport, west of Melbourne. Okay, there it is there. There's the estate they purchased in. There's the house that they actually purchased. It was a 24 square house, 4 bedroom, double lock-up garage. It's going to do 8% per year. It's not going to do any more. Don't buy into this propaganda about scarcity in these areas. It doesn't exist. There's infinite land supply in all the major capital cities. The suburbs that would do 12 to 15 are in the city areas. Established suburbs that have already been developed. But we're realistically planning to buy more property. How much is the property costing them? Nothing. Now, if you're paying tax and you've got a deposit, why isn't everyone doing this? Just to get rid of your tax? When I show this example, I just don't even know what more I should show people to convince them that property is a good investment. Do you know what I mean? It's either your money goes to the government or it goes into your own property. It's that simple. Even at 8%, why don't you just sell it in 12 years' time and just take out 400 grand and blow it, buy a Ferrari? Isn't it better just paying tax to the government? That's insanity, isn't it? It's all legal. Due diligence. This is what you need to know. This is what we teach you. We teach you the 52-point criteria. We also teach you how to use the property investor analysis software as well, which allows you to crunch numbers on these properties. Some of the criteria that we use on our property selection are this. We look at the 10-year capital growth averages of our properties. They need to have 10% according to RP data over 10 years. Rental yield averages, at least 5% increases. Population growth has to be positive. Income bands, so we need to study the demographics of the area. Income earning averages, population growth, infrastructure, transport, shopping centres, schools. Just goes on and on and on. I'll show you some of these properties. The 2-day property seminar. Now, if everyone can just grab this form here. This is the 2-day finance property mastermind seminar that I'm running in Brisbane in January. You will learn from a senior accountant, a financial planner, a finance expert, an insurance specialist, a property portfolio manager, a quantity surveyor, a due diligence expert, an options trading expert. We're going to teach you how to structure and build the large property portfolio from scratch. What you've seen there is just a summary. It's a very rough, brief summary of what we do. This really takes 2 days to explain in detail. Okay, so what I've done, I've just summarised it very quickly. We're going to teach you how to do this. We're going to show you advanced finance and property portfolio and structuring techniques, advanced asset protection and risk insurance, how to generate cash flow from your property portfolio, 6 ways to buy property with no money as well, how to use the property investor analysis software. I'll show you how I can make a decision in like 7 minutes to buy a property. It's very simple. Anyone can do it. Also, we teach you the 52-point criteria as well. And we show you the exact location, size, zoning, and type of property you should be targeting in order to outperform the market. Even the size of the property makes a difference. Sometimes if it's too big, you're overpaying unnecessarily and you won't get it back through rental. So that's not a good thing. How to negotiate with real estate agents. We've got a real estate agent spending 2 hours on how to talk to agents, how to do it, and this guy trains agents. He's been a real estate agent himself over 20 years. Now, I'm just going to very quickly, I went over time, but I'm just going to go through a 21st Century Property Direct membership. The membership, what we do as a company, is basically, the membership is designed to fast-track your wealth plan by giving you a team of experts that can help you to build your property portfolio. Who would agree that one of the hardest thing to find is people that know exactly what they're doing and then getting them to help you to do what you want to do? Yeah, getting the right accountant, the right solicitor, the right conveyancer, the right broker. And that's what we do. We put all the people that you need together and then they help you build your large property portfolio. We've got 21st Century Accounting, Finance, Property Direct, and Insurance. We also have external companies. We've got a solicitor that we recommend in every major capital city, and this solicitor, all they do is property law, nothing else. And we've got a quantity surveyor that we use in every major capital city, and all they do is depreciation schedules on properties. By becoming a 21st Century Property Direct member, you'll be coached and mentored by successful investors who've got real measurable results. So Nigel Kibble, Craig Webb, and myself. Craig Webb is at the back of the room. Craig, just wave to everyone. Craig lives in Queensland. He's also an expert on the market in Queensland. He knows a lot about the market here. He's in charge of all the projects that we source in Queensland. So if you're interested in investing in Queensland, please see Craig during the weekend, make an appointment, and he can sit down and go through the properties. I only specialise in Melbourne. If you want to invest in Melbourne, come and see me. I can talk about Melbourne stock and all the projects that we've got up and coming in Melbourne. So Craig is an expert on Queensland. I'm an expert on Melbourne. Duncan Hall and Nigel Kibble are an expert on Adelaide and Sydney, and that's all the markets that we do. We don't do Perth, we don't do some of the smaller markets yet. Based on a personalised wealth plan, you'll gain access to blue chip investment properties sourced from the open market by myself, Duncan Hall and Nigel Kibble. And all we do is we drive around, we speak to developers and builders, and we take out entire projects. Okay, we get exclusivity over entire projects, and we negotiate discounts for our clients. You get a property analysis based on your personalised information and based on your current financials. We currently have properties at up to $50,000 below independent bank valuations. Now, they're not always available. They come and go very quickly. What we do is once we work out what properties are best for you based on your current tax, income, assets and liabilities, once we find that property, you get notified and you can take that opportunity up or not. I'll show you some examples. We've got new developments coming on board every 2 or 3 weeks. Any developers in the room? No? There's one. If you've got any products, if you've got any developments that you might have that fit our criteria, come and see me. We have picked up a lot of developers just because they attend our workshops. And developers work on a profit margin. They just want to sell their stock. They're unemotional. Providing the stock passes our criteria, we will offer it to our clients. If it doesn't pass our criteria, we don't offer it. I would say we reject 70% of all the properties that we see, on average, 75%. We do house and land. We do townhouses and apartments. We specialise in sourcing residential investment properties based on strong fundamentals, located around major capital cities. Queensland is the exception. Queensland, for example, the Sunshine Coast, the Gold Coast are great opportunities, as well as Brisbane. You've got a unique situation here. Melbourne and Sydney is very basic. It's just 10 to 15 k's from the city, depending on which part of the city. Where in Queensland, especially like the Caboolture Shire, for example, is one of the fastest growing areas in Australia at the moment. So if you guys can get the knowledge of which properties to pick in the Caboolture Shire, in the Sunshine Coast, I would go in and I would be going in hard now because of all the infrastructure that's going up there. If you want to know more about that, see Craig during the weekend. We offer asset protection advice, insurance, legal conveyancing advice. We can get you 100% finance. We can help you to secure these properties with as little as $1,000. The thing that's unique about our company is this. We give you peace of mind. We physically give you a current valuation on each property from a bank panel valuer. So I'm talking about Heron Todd White, Charter Kramer, WBP. And we also give you a written rental appraisal from the local agent on every property. So you physically get these two documents. Bank valuation, written appraisal. Is that good information to have when you're buying a property? You can take the valuation to the bank and borrow against it or get it redirected. So you know exactly what your property is worth. The sourcing service, so currently we have house and land in Melbourne, Melbourne apartments, townhouses, Queensland, Brisbane, Adelaide, plus many others. A couple of examples that we've just settled. In Carrum Downs, this is one property, $300,000. This property is cash flow positive by $13 a week. This is in Doncaster, $558. This property is cash flow positive by $21 a week. I'm just going to go through these fairly quickly because I want to get to the end and running behind schedule a little bit. This is a townhouse in Altona, $650, and that's cash flow negative by $20 per week. And this is a $650 townhouse, 9 k's from the city. The currently house and land, I'll show you one estate in Melbourne that I think is okay because it's got a train station being built there. There's 3, out of the 27 estates that we have in Melbourne, 3 of them have train stations being built in the next 3 years, and Westfield shopping centres are going in there as well. Do you think that's going to make a difference? This is Point Cook in Melbourne, 22 to 24 k's from the city, Bayside West. This is what it's going to look like in a number of years from now. A lot of infrastructure going up there. We select the blocks as well. I like blocks looking... Do you think blocks overlooking a park will do better in an estate than overlooking nothing? I wouldn't spend more than $420 in Melbourne on house and land. Okay, any more than that, you won't get it back in rental or capital growth. So $420 is the max. 4 bedroom, 22 to 24 squares, plus a study, plus alfresco area. That's the kind of properties that we source in Melbourne. Typical block, 450 square metres to 500 square metres. You're getting a rental of $350 to $380 a week. These properties will do 6 to 8% per year. That's it. Okay, if anyone tells you otherwise, you've got to study the market. Look at the last 30 years of these estates. Okay, there's just no scarcity, but you won't lose money on them. It's a good way to get into the market. It's like buying home brand, you know? You can't lose, but you're not going to get excited, right? But it's good. They're the estates that we have. Townhouses is my favourite investment, and apartments, especially waterfront apartments and townhouses in established areas. This is in Adelaide, for example, Newport Keys. Some of the villas here, I'll show you one villa for example. These are the villas that I'm particularly interested in. Adelaide has the biggest open mine being built there in the world. Okay, it's got a contract, it's got a lifespan of 150 years. Contract with China for uranium and copper and iron ore. 150 years is pretty good, isn't it? These are some of the properties there. These are the villas. I'll just show you one in particular. And this is a villa that you can lease to a corporate middle manager from BHP or corporate leasing. That's the internals of the villa. You can get these fully furnished. Very high depreciation benefits. 3 bedrooms overlooking the water. That's the estate there. That's the actual property. And there are $100,000 discounts. So we've got these, they were originally $679, $990. We've got them for $579. Why? Because Urban Construct, who's an absolute giant of a developer, they've got $2 billion invested in this project. They just want to get rid of the last stage to start the next one. They don't particularly care about the $100,000. It's just that simple. So, you know, because we deal with them in bulk, that's the kind of discounts we can get. This is David Street, Altona. 4 townhouses in Melbourne, near the water, walking distance. I'll just show you the location of the map. Now, if you're looking at a townhouse, the 2 things that I look for in townhouses in Melbourne and Sydney is the master bedroom on the ground floor. Why is that important? What demographic that is aging now, that might be downsizing, doesn't like walking upstairs to get to the bedroom? Is it also good to have an alfresco area in Melbourne and Sydney where it rains 8 months of the year? So you can have a barbecue under roof. Absolutely. Is that a good location there? There's the property. It's walking distance to the beach, to the main restaurant strip, to the highway, to the train station, and it's within, I would say, 500 metres of 3 schools. Is that a good location for a townhouse? It ticks all the boxes. So these are the kind of properties that I source and I personally invest in these developments. There's only 4 in that one. That project is actually no longer available, but we've got projects like this all the time coming up. Apartments, this is Aspendale in Melbourne. Okay, once again, near the waterfront. Who believes that properties near the water will do better than properties not near the water? This is the photo of the actual beach at the end of the road that I took. That's the actual, it's one of the nicest beaches in Melbourne. Aspendale Beach is one of the nicest. That's the actual views from the first floor, from the balcony. Is that a fairly good view for Melbourne? I mean, we haven't got beaches like you guys have here. Come on, but for Melbourne, it's pretty good. This is Ascot Vale Apartments. There's 27 in this one. It's 4 k's from the city, and we've only got 6 that are owned, that are sourced by our company. The rest are going through agents and they have owner-occupiers in them. So the 21st Century Property Direct membership is based around us helping you achieve your goals. It's been great spending this time with you. I wish you all the best in your future investing endeavours. Thank you very much.